I get it. You're juggling family, work, college, and a million other responsibilities. You don't have the time to sift through endless financial reports or worry about market swings. You just want something simple, reliable, and effective. Something that puts money in your account month after month without the headaches. Stick around because I've got exactly what you're looking for. Ready to unlock a passive income stream in 2025? In today's video, I'm sharing 3 powerhouse dividend stocks that can help you generate passive income next year. These aren't just any stocks. They're what we call SWAN stocks. It's called this because you can sleep well at night investments. Why? Because they're high quality, low risk, dividend-paying stocks designed to keep your income steady and your stress levels low. So stick with me and please don't forget to like, subscribe, and leave a comment just below. I always answer all of you guys. First of all, I want to give you a bonus in this video. I'll teach you how to analyze a dividend stock. And I know what you're thinking. Analyzing stocks sounds complicated, but trust me, it doesn't have to be. Let me break down into simple steps that anyone can follow, even if you're new to investing. When it comes to dividend stocks, the first thing you should look at is the dividend yield. This tells you how much income you earn relative to the stock price. For example, a stock priced at $100 that pays a $4 annual dividend has a 4% yield. It's simple, right? But here's the thing. Don't get caught chasing high yields. Here's where you need to be careful. If you see a stock with a really high yield, like 10% or more, that might seem like a great deal, but it could actually be a warning sign. A real example of a high-yield stock that crashed is General Electric during the late 2010s. At one point, GE's dividend yield appeared very high because its stock price had plummeted. Investors who were drawn to the seemingly attractive yield were shocked when the company announced a dividend cut, reducing its payout significantly. Think of it like a discount sign at a store. Sometimes it's a great deal, but other times it means something's wrong with the product. Instead of focusing only on the yield, look for moderate yields, like 2 to 5%, from companies with a strong history of paying and growing their dividends. Now let's talk about earnings per share, or EPS. This number shows how much profit the company is making for every share of stock. If EPS is growing, that's a great sign. It means the company is making more money and might raise its dividend in the future. You also want to consider the price to earnings ratio, or PE. This helps you figure out if the stock is fairly priced compared to its earnings. A low PE might mean the stock is undervalued, while a high PE could mean it's overvalued, or that investors expect big growth. Another thing to look at is the company's market capitalization. Basically, its total value. Larger companies are often more stable and reliable for dividend investors. And finally, always check for risks. Even the best companies face challenges, whether it's competition, economic downturns, or changes in consumer trends. Knowing the risks helps you make smarter decisions and diversify your portfolio. So there you have it, a simple framework to analyze dividend stocks. And now let's put this to the test with 3 dividend stocks you can use to build passive income in 2025. First stock is JP Morgan Chase & Company, or as most of us know it, JPM. This is one of the biggest names in global banking, with services covering everything from regular consumer accounts to high-level investment banking. Basically, it's a financial powerhouse operating across 4 key areas: consumer banking, corporate investment, commercial banking, and asset management. Now let's get into the numbers. As of November 2024, JPM's stock is trading around $248 with a solid market cap of nearly $700 billion. Its price to earnings ratio is 13.81, and it's pulling in $18 per share in earnings over the last year. That's some strong performance. For dividend lovers, JP Morgan pays an annual dividend of $5 per share with a yield of about 2%. Not bad for something this stable, right? The dividend payout ratio is approximately 27.78%, which shows that JP Morgan is using less than a third of its earnings to pay dividends, leaving plenty of room for reinvestment and growth. Here's what that means for you. If you own 10 shares, you would earn $50 per year. With 20 shares, you'd make $100 annually, and 30 shares, that's $150 in dividends every year. 40 shares would net you $200, 50 shares brings you $250, and 60 shares, you'd pocket $300 annually. With 70 shares, it's $350, 80 shares, $400, and 90 shares, that's $450 in dividend. And finally, if you own 100 shares, you're looking at a solid $500 every year. And also, if you're wondering about growth, in 5 days, JP Morgan grows 1.97%, in 1 month, 11%, in 6 months, 24%, in 12 months, 46%, in 5 years, 91%, and since 1985, 4,860%. It's impressive, right? That means that if you had invested $1,000 in 1985 without the dividends, you would now have something very close to $49,000 in your bank account. It's not that flashy, but it's dependable. JP Morgan has a diversified portfolio of services, which helps it weather storms in the market. Of course, it's not without risks. No investment has zero risks. Things like interest rate changes or economic downturns can shake things up, so keep that in mind. JP Morgan Chase faces these main risks. First, regulations. Breaking rules can cost them big fines, like $151 million in 2024. And markets, things like inflation or global conflicts can hurt their profits. Operations, because mistakes happen, like the $6 billion trading loss in 2012 showed the danger of poor oversight. Reputation, funding controversial projects like fossil fuels can damage trust. Cybersecurity, because more online services mean higher chances of hacking or data leaks. But this is a good stock overall, and to date, it has delivered good results. Keep studying, following, and draw your own conclusions. The second stock is the Procter & Gamble Company, or as most of us know it, P&G. This is a global giant in consumer goods. It's the name behind brands we all know like Pampers, Tide, Gillette, and Olay. From baby care to beauty and grooming, P&G has products in almost every home worldwide. Now, let's get into the numbers. As of November 2024, P&G's stock is trading around $172.75, with a market cap of nearly $407 billion. That's the size of some entire economies. It's pretty impressive, right? Its price to earnings ratio is 29.78, and it's pulling in $5.8 per share in earnings over the past year. Solid numbers for a household name. And for the dividend lovers out there, P&G pays an annual dividend of $4 per share with a yield of 2.33%. Not the highest out there, but reliable and steady. The dividend payout ratio is approximately 69%, which shows that P&G is returning a significant portion of its earnings to shareholders while still keeping some for reinvestment. Here's what that means for your pocket. If you own 10 shares, you would earn $40 per year. 20 shares, $80, 30 shares, $120, 40 shares, $161, 50 shares, $201, and if you own 100 shares, you're making a solid $403 annually in passive income. Now let's talk about growth. Over time, P&G has shown steady performance. In the last 5 days, it grew 4.2%. In the last month, 4.8%. 6 months, 7.6%. In 12 months, 21%. In 5 years, 47%. And since 1985, 12,344%. That means if you had invested $1,000 in P&G back in 1985, excluding dividends, you would now have about $124,000. And talking about risk, with P&G, you've got to keep an eye on things like commodity prices, competition, and currency fluctuations. Actually, things that can impact global businesses like this. But at the end of the day, P&G is a powerhouse. It's not flashy, but it's reliable. A classic dividend growth stock that can anchor any portfolio. And the third stock is the Coca-Cola Company, or as we all know it, Coke. This isn't just a soda brand. It's one of the most iconic companies in the world. Coca-Cola operates in over 200 countries and offers a diverse portfolio of beverages, including sparkling soft drinks, juices, teas, coffees, and even bottled water. Now let's get into the numbers. As of November 2024, Coca-Cola's stock is trading at $56 with a market cap of approximately $242 billion. Its price-to-earnings ratio, the PE, is 22, which reflects steady earnings for such a mature business. Over the last year, Coca-Cola has delivered $2.48 in earnings per share. For the dividend lovers out there, Coca-Cola is a classic income stock. It pays an annual dividend of $1.84 per share, which translates to a yield of 3.28%. A solid choice for those looking for dependable passive income. The dividend payout ratio is approximately 74%, highlighting Coca-Cola's focus on returning a significant portion of its profits to shareholders, while still reinvesting for future growth. And here's what that means for you and your pocket. 10 shares, $18, 20 shares, $36 annually, 30 shares, $55, 40 shares, $73, 50 shares, $92, and finally, 100 shares, $184 annually. Now talking about growth, over time, Coca-Cola has proven to be a resilient company with consistent performance. In the last 5 days, it grew 1.15%, in the last month, 2.25%, 6 months, 4.85%, 12 months, 9.42%, 5 years, 22%, and since 1985, 24,000%. If you had invested $1,000 in Coca-Cola back in 1985, excluding dividends, you would now have about $243,000. And that's without factoring in the power of reinvested dividends over time. When we talk about risk, Coca-Cola faces challenges like changing consumer preferences, competition, and fluctuation commodity prices. But its strong global brand and diversified portfolio give it resilience in almost any economic climate. Coca-Cola isn't just a drink, it's a cornerstone of many portfolios, delivering decades of growth and income. A true classic in the world of investment. Well, that's it. Cousins, I hope you enjoyed this video and that you can benefit from the knowledge I left here. Seeking passive income is the best decision for those looking for financial freedom. If you watched this video until the end, the first step has already been taken. I'm sure that you will be able to achieve your goals because you have the desire and seek knowledge. Don't forget to like, subscribe to the channel and comment. I respond to everyone, so see you soon and thanks for watching.